Good afternoon, everyone. This is Mark Robertson with the 506 Investor Group. Today we have another of our sponsor webinars. We have Stephen West and Anthony to go over the StepStone VC Secondaries Fund 6. But as usual, the first 30 minutes will be their presentation, and the second half will be a Q&A. So if you have any questions during the presentations, please type those into the chat box, and we'll ask those at the end. But for now, I'd like to welcome Stephen and Anthony. How you doing, guys?
Thanks, Mark. Really appreciate it. Just a quick intro here because I know we've got half an hour. So Stephen West, Managing Director on the StepStone Venture Capital and Growth team. Both Anthony and I come from the legacy Greenspring Associates side, having been with the firm for a little over 6 years now. I probably spend a little bit more of my time on fund secondaries and fund primaries, but we all work across funds, directs, and secondaries as part of our platform. I'll turn it over to Anthony.
Yes, Anthony Giambroni, also Managing Director on the VC and Growth Equity team at StepStone. Have been on platform with Stephen since the summer of 2017. Stephen mentioned, I'll kind of take the athlete approach, but my major minor is probably a little bit more on the direct side of the house, where I spend a lot of time on direct primary and direct secondary activity. Before joining what was Greenspring back in 17, was a growth stage investor at a firm in Salt Lake City, Utah, and an investment banker prior to that.
Okay. So just a quick overview on StepStone. So Greenspring, just to start there really quickly. So Greenspring was founded in 2000. Really to be the venture arm for T. Rowe Price initially, so it was incubated inside T. Rowe Price. 2000, obviously, a different time in venture, and so T. Rowe had just bought out its JV with Russell Investments, the international arm, and so the executives there encouraged our founder Ashton to spin out, launch Greenspring on his own, and they backed him personally as a part of that. From day one, Greenspring was investing into both fund primaries, directs, and secondaries. At the time, you were either a fund of funds or you were a direct investor, and nobody was touching secondaries. But we had always believed from the inception that one of those investments in one of those arms to get information and relationship advantages in the other pieces. And so slowly built that business over the course of 21 years until we were acquired by StepStone to be their venture capital and growth arm. Today we manage about $30 billion. We've got 150 people, the largest team in venture. Half of those are investors. And run rate today, we're investing about $5 billion annually into the asset class. So we are the largest investors into venture capital globally. I'll kind of skip this, but we offer a number of strategies for our institutional and other clients, really to serve as their entree into the venture capital ecosystem. And so we really try to be a solutions provider for folks as we're looking to get exposure into venture, whether that's through our core flagship fund of funds, what we're doing here on the secondary basis, which is extremely attractive area, particularly today, or stuff that's maybe more direct in nature. I mentioned 150 people. As you can see here, the boxes in the blue, the 8 partners from Greenspring all carried on into StepStone. We were joined by 3 partners from StepStone who were historically more focused on venture and growth. That's Brian Borton, Andrew Callahan, John Coelho. As a part of the combination, we've been able to build, we have our teams now and colleagues in different geographies as well. So full office in London, full office in China, and that just helps us continue to see opportunities globally by having folks on the ground. Our industry advisory board is one of our pieces of secret sauce. So we these folks on our board here, whether it's Barry Eggers at Lightspeed, who is the investor behind Snapchat, Anthony Lee, who led the investment in Roblox, Bob Goodman, one of the leaders at Bessemer. We tend to do about 85% of our deals with these individuals or their firms. We have a really close alignment with them. So we are often their largest investor. I've referenced that $5 billion annually into the ecosystem each year. We sit on their advisory boards. They are all personally invested in Greenspring through their family office. And so there's a ton of alignment in these transactions. So it's never about one transaction, as they're looking at how the advice that they're giving us or the insights that they're giving us, it goes back to that, we are often their largest investor, and a meaningful partner for them across their business. The other piece is what we're doing with the strategic advisory board. So this is where we're working with Fortune 100, Fortune 500 corporate leaders to connect them to the innovation economy. And that's where, groups like Marriott that needs to find innovative businesses to help them improve their core business, connecting them with, the long tail of venture companies that are out there. And so this is really interesting for the funds that we work with, because as an LP, we're actually delivering customer introductions that could be, again, potential customers from a proof of concept level, even from a proof of concept level, potential partners, or even potential acquirers down the road. And so if we're seeing a group like Intuit or Novartis actually invest, become a customer company or invest in that company, it's a great signal for us as well that this is another business that we want to spend time on. All this leads to our portfolio impact team. So our portfolio impact team, again, as a limited partner, often limited partners are just showing up with their capital. We work really hard to make sure our dollar is worth more than $1. And so you see here, we've made close to 3,000 customer introductions to our underlying portfolio companies since the inception of this program. So we have a dedicated team that 24/7 just supports the ecosystem, and it's a real differentiator for us as an LP into the ecosystem. Anthony, you want to hit information relationship advantage here?
Yeah. I mean, I think as Stephen had kind of mentioned earlier, it's our scale and our annual deployment into the venture and growth asset class that really acts to differentiate us and providing kind of core sources of edge, one of which is kind of our informational advantage. So think of that as, us having a very wide aperture, probably almost 300 different venture funds that we're invested in today. But the broader platform at StepStone is covering, as you can see, about 16,000 different GPs across 40,000 funds. And that comprises a look through to about 80,000 different companies. So, just really have a ton of insight and information that we're able to glean as, we're extracting information that comes not only from quarterly reports, but going to the annual meetings, being on the LPACs of all of these firms. It's just a great source of edge, very proprietary data that, not a lot of other people are able to replicate given our size and scale. And then this is kind of what I was mentioning, from a relationship perspective. One of the benefits of the combination with StepStone was really increasing that aperture of the groups that we were working with within the venture landscape. So, while we had great coverage at Greenspring of about 90 managers, now with the combination of our legacy discretionary business with the StepStone advisory business, we now have a look through to about 280 managers. I think today probably closer to 300. So, overall, that just once again feeds the informational advantage, and it also kind of feeds our flywheel with respect to co-investment, direct, primary, secondary, et cetera. So a really powerful platform on a consolidated basis and looking forward. And Stephen and I probably joke a lot, as you look at this slide, it's a little bit hard to digest, but what it's really trying to articulate is the power of the platform and the flywheel model that we ultimately employ. You can see from some of those fund investments that we've made on a primary basis, it has led us into some great direct primary investments as well as direct secondary investments, over the course of our 23 years investing together. So, once again, a very powerful model. It probably works a little bit better at scale than we ever anticipated, but we are happy to kind of continue to compound and press the edge that we have.
So let me pause there. Happy to take any questions on StepStone. Otherwise, we'll just kind of get into the market. Okay. I'll skip that first slide. So, I'm sorry. Was there a question?
Stephen, just trying to reiterate, all the partners or the principals who were there in the Greenspring before the merger, are they still the same principals and founders going to manage this new fund going forward, or any of them left the company?
That's right. Yeah. No. The same partners going forward. And again, if you think about the actual dynamics of the investment committee, the legacy Greenspring partners had 8 of the 11 seats, and so you know, kind of a super majority there from a voting perspective, if that ever came to pass. Thank you, Sharaf, for the question. So, you know, as we look at the secondary market, it's really interesting. I think, you know, the number one piece is you saw, particularly like the start of this year, the end of last year, you saw this denominator effect where you had a lot of institutional investors where their portfolios were just out of whack from their investment policies. So E&Fs, corporate pensions, and they were basically forced to sell, right? As the private books had remained high, public markets had gone down. So there was a lot of transactions, and this still remains as a driver for some of the folks in the ecosystem, because the only way to really solve the problem is to either A, kind of like hold through it, or B, to sell. And so for a number of reasons, some folks have looked to sell, and you can kind of see that played out during the global financial crisis, where, you know, there was 2.5 times more transactions post GFC than there was prior to that. There's also just a ton of unrealized value that remains, and there's really limited past liquidity for that value. So as you think about, you know, over $1 trillion of unrealized NAV in venture funds, the IPO window, you know, for better or worse, probably remains pretty tight. You know, Instacart hopefully will have a nice listing here shortly. You know, Klaviyo is also, you know, is also there, but, you know, more until the end of next year is what we continue to hear from the investment bankers in terms of when you may have significant IPO activity, and then realizations and distributions. And so as you have had all this capital called and is starting to be called again, investors just do not have the realizations that they would have expected, and so they're also being forced to make decisions in terms of selling down some of these positions. What's interesting about that today, relative to the GFC, though, is performance now is much better than it was during the GFC. So if you look at performance here, you know, most of these funds, when we're looking at them, are kind of like a 3x or a 4x. So even if you're taking, let's call it a 50 cents on the dollar discount, you're still coming out with a 1.5 to 2x. And for most sellers who are like, hey, I made a little bit of money, I get to free up some capital, I can reallocate, so it's not a problem. Whereas during the GFC, as people were focused on this distressed selling activity, you were really having to sell below cost. So that's another reason that folks are more willing to transact as they look at this period of illiquidity that's staring at them for the next, you know, 6, 12, 24 months. The other piece is there's been a lot of emerging managers that have raised. I'm sure many of you have seen the amount of small emerging VC funds that have been raising over the last several years. You know, the market has exploded. There's over 2,000 of these managers today. And so as they're coming back to market, a lot of them raising funds 3, funds 4, fund 5 have 0 DPI. And so investors are saying to them, hey, if you want me to invest in this next fund, you're going to have to provide me some distributions. And with our secondary fund, we're well positioned to do that. One, because we know the assets really well, but two, we're particularly attractive to these emerging managers because we could be a source of primary capital to them later on. And so it's not purely a one-time transaction. Oftentimes they look at it in terms of, one, StepStone has a high certainty to close and get the whole transaction done, but two, like, you know, now I have a natural touch point with StepStone where I can give them an update on how my funds are going. And when you have that familiarity, it can often lead to, you know, a further investment down the road through one of our other discretionary vehicles. These GP-led transactions, and I know we got a question on pacing here that came through prior to the conversation. So these GP-led transactions, you know, you may have seen these in buyout, whether continuation funds or strip sales. They've been pretty nascent in venture historically. Before COVID, we'd had a transaction with NEA. We had led the Altos transaction at $450 million, but you're starting to see these pick up again. So again, I'll come back to this later with some of the questions, but a transaction for a large platform that we have a ton of exposure with is just coming about for $1.2 billion. We're looking at a transaction for a fund that has $700 million in NAV, and so these really big chunky transactions are one of the reasons that we increase fund size to be able to do those. And we think it's going to be a big leg of the stool going forward, particularly as the market for those reopens. Pricing, again, I think in this period of dislocation, pricing has been phenomenal. We have been often pricing things well below this data here, which is from Jefferies. That being said, though, and another of the questions we got from the ahead of time is what's the reference point? It's a fantastic question. And the reason that it's a fantastic question is in a bull market, the value of our platform isn't as apparent in today's market, because in a bull market, all the funds are marking things to the last round pricing, but that's not what's happening today. You see a bunch of different marks, whether something is 20% down or 50% down or more, or held at last round pricing. And so because of the amount of information that we have from the $5 billion that we're deploying annually, the close to 300 manager relationships, we often have 4 or 5 different managers in each of the value driving companies. And so it helps us get a sense of what is the true value for this business today? And then what's the discount that we'd be willing to pay off of that? And so as managers have marked down portfolios, that obviously changes the discount for what we're willing to pay as well. So again, just one piece of our platform that's been particularly relevant over the last several quarters is to have that insight into what the individual companies are marked at the secondary funds that we're looking at, and is that the right mark?
Well, that brings the question up just in general. How do you get comfortable with the NAV that the underlying fund says they're worth? I mean, like you said, it could be based on the last round, but the round was 8 months ago when the markets turned. So it's the valuation can't be anywhere close to the last round. It would probably be a down round if they raised one, but they're not going to raise one because it's a down round. So that seems like the hardest part of this puzzle.
Yeah, it's a great question, Mark, and Anthony should hit it. I think a lot of it is really understanding. Anthony, you want to talk just how we focus on the value drivers and less about the manager or otherwise?
Yeah, it's probably the hardest part of the puzzle for new entrants that are trying to attempt, to make a play in VC secondaries that don't have the level of granularity that we have with data. In many instances, these secondary transactions on the LP side are still driven to chase certain assets that we have been watching for quarters and years in different early stage portfolios where we've been collecting metrics on financial performance, et cetera. And so for us, I would say secondaries probably ends up being the biggest beneficiary to our broader platform-based approach. And because we have the opportunity to be a part of a limited auction process, have such a deep relationship with the GPs at all of these funds, what we're really doing when we price the underlying assets is triangulating what is a fair comp or a comp set for a company in a given market relative to the fundamentals of the business today. And that's really how we price. So, we're taking a view on what is something worth in today's market context relative to its growth and top line revenue. Most of these businesses, as you all could imagine, are not yet profitable or generating EBITDA. So, us having the direct practice, us having the granularity of data, the information, we're drawing a view on pricing based on metrics today, and then what we think it could be in the future based on our guidance on forward growth that we may get from our managers. So it's a huge differentiator that we have, and you really can't unlock it without the scaled primary business. But it does kind of take some of that direct know-how, which is why, our team working across the depth and breadth of what we do here, both funds, directs, and secondaries, it becomes beneficial because we do have kind of that skill set and do have a very long track record of successful direct investing, which at the end of the day, that's what you're doing. You're just kind of doing it through the wrapper of a fund and what may be kind of 3 to 5 companies from an NAV perspective that are going to drive most of the value at the end of the day. Anything else on that, Stephen, that you would hit?
No, hit it. And while we think the direct secondary market, for a little bit, it's been a pause for some of the reasons, Mark, you just outlined, where it's the last round price is just totally out of whack. We think that's going to come back, and some of these rounds will also be getting done, which will serve as a new anchor. But it's always very metrics and fundamentals focused. So happy to take any questions on the market before I just kind of go over to the strategy. Okay. So for Fund 6, this is our 6th venture secondaries fund. Our target is 2.75 billion. We're investing everything across funds. That includes typical LP interest, tenders, strip sales, continuation funds. Again, all those count under our fund bucket. And then direct secondaries, which is we're just buying from departed employees or early investors working through the company to do this. We're not kind of like trolling LinkedIn or anything. It's a pretty flexible check, so everything from a couple $1 million up to 100 million plus. That tends to be a nice differentiator for us because we can move quickly, but in a way that finds a way to do a successful transaction. And as Anthony has mentioned, the deal flow is really we get from our primary fund business. We don't think that our secondary strategy would be successful if we were not the largest investor in a venture, full stop. The venture secondary market, we talked a little bit about some of the dynamics, but it's still pretty unique as related to the buyout. Venture, if you're looking something on secondary market, the traditional valuation methodologies, as Anthony mentioned, these businesses aren't EBITDA. Positive, and so you can't run a free cash flow model to have a view on like what the business could be worth in 3 to 5 years, and information to make that underwriting. Anthony, am I freezing? I got a poor connection notice.
Yeah, you froze up during that last segment for a little bit.
Okay. Do you want to hit this, Anthony?
Yeah, I think part of it was what I was kind of mentioning, that venture just generally tougher to diligence. Just underlying companies in VC tend to not have earnings or profit, so you're not going to be able to kind of build DCFs. You're not going to have just kind of a visibility on cash flow to kind of underwrite how traditional buyout LP secondary shops might ultimately look at portfolios. One of the other huge embedded advantages that we have is a lot of these funds have GP transfer restrictions. And so, what it really does is it limits the set of potential buyers in the market, because the GPs can effectively tell the selling LP who they are allowed to sell to. And many times it has to be somebody that's already a part of the existing fund's LP base. So, when you think about our positioning from the fund primary perspective, it keeps us around the hoop in a lot of these conversations. And most of the time, we are probably one of the preferred buyers, just given our brand and reputation in VC secondaries. At the same time, you don't really have as many brokers involved in the venture market because of some of that inefficiency in the market. We do see brokers, obviously, as a part of the continuation funds. Just GPs have a fiduciary responsibility to kind of relay that there was fairness around how things were priced. But in the more traditional kind of one-off LP sales, we don't tend to see brokers in a lot of those. And then, kind of finally, it's once again a scale perspective. There's not a lot of groups in VC secondaries that could take down some of these opportunities that we suspect over the course of 24, 25, and into 2026 could be tickets that are 100 or even 200 million in size. So we wish in retrospect we could have spoken for more of the Altos transaction, just given what the potential for it is at the end of the day.
And the GP transfer restrictions is just to give you a real-time example. We're working on something where the seller had an agreement to sell a position at 40%, and the GP actually said, you can't sell it to that person, you can only sell it to StepStone. And so we have since said, hey, we'll buy it for 50 cents on the dollar. And it's just one of the unique pieces of venture that we like to take advantage of here. But it's only because of what we're doing on the primary fund side that we're able to have that position. We leverage all the data that we're using. Again, we've got a very big team to be very proactive on our secondary program. So we're reaching out to GP saying, hey, we think we could offer this sort of discount, or we think that this fund would be a great position for a strip sale. We do a ton of content education with the GPs to really be the partner of choice and the solutions provider for them as they consider something in the secondary market, given that it's a bit still, even for older GPs, still a bit more nascent to them as they haven't often experienced a lot of it. You know, we're doing a lot of different types of transactions, as I mentioned, the outside of the strategy section, whether it's, again, direct investments where we're working through the board with the company with the full information, with LP interest where we're buying from a seller, but also things like strip sale, where, again, with Bloomberg Beta, for example, here, when Michael Bloomberg was running for president, he had to fund that campaign. One of the ways he did it is they sold off a strip of his interest in Bloomberg Beta, which was a captive VC fund. We were able to exclude one of the assets, Notel, which was, kind of subsequently went to zero, which is great for us to exclude. And it's been a fantastic outcome for us, well over 3x already. But we're also doing LP tenders. That's where we go to the LP base and say, hey, we're willing to buy X amount at this price. Who wants to fill it? Again, we can do something that's very chunky with them, or things like continuation funds, as Anthony mentioned with Altos or Giza, where we're really honing in on a couple key assets that we think, the fund is at its fund life, but they still have the opportunity to compound at greater than 50%, rather than doing something artificial like selling them. Let's partner together to do a continuation fund. You've probably seen some of those in buyout as well.
Which of those strategies? Which of those strategies has historically been the most profitable? Which can you get the biggest discounts?
I mean, the directs have, some of the directs have outperformed. If you look at like Wuhan and Fund 1 and 2, it's like a 20x across those two funds. The continuation funds, the Altos transactions well north of a 6x. It tends to be, I mean, the directs have the potential probably like for the greatest band, but we really do go after concentration with even the fund investments, because we feel like we can pick the best assets. And in venture, the whole game is like, can you get exposure to the best assets? And often on the fund side, particularly in this market, you can access the best companies without paying the highest price or even nearly close to the highest price.
And at this stage of the market, which of those strategies has the greatest amount of access?
Yeah, today certainly I think the fund secondaries are where we're seeing like the most interesting opportunities today. Again, given some of the stuff you mentioned earlier, Mark, where last round pricing was serving as an anchor on some of those direct secondary opportunities, like people just weren't willing to take 90% discount. But you're starting to see some of the reset in the direct secondary market where people are throwing out that last round price and we're going back to more of a fundamentals approach. But also there's just dislocation on the fund side. So you have distressed sellers, people that don't see liquidity coming and are willing to sell or facilitate a transaction from the GP-led perspective in order to save their business. And when I say their business, like these emerging managers, if they don't create DPI for their investors, they face legitimate existential risk, right? Like you could see them not being able to raise their next fund if you look across everything that they've raised and they haven't delivered capital back to their investors.
Thank you.
Anthony.
Yeah, and I know we're at half past, so I'm not sure if we want to keep diving into strategy things or if it would make sense to.
No, you can keep going for a little bit. I mean, I stopped you with some questions, so you can another 5-10 minutes on this.
I mean, this is probably one of the benefits of us having as scaled of a team that we have. Probably have about 80 folks focused exclusively on research and investments. And what it ultimately enables us to do is get a very granular look into the underlying portfolios and to really assess attribution on a partner by partner basis. So, really during our primary fund diligence process is where a lot of this starts, and it helps us start to separate, which one or two partners at a given firm, which you can see here kind of outlined in the green box, are really the money makers, driving kind of the highest multiples on a fund level. Whereas you can see some of the partners are maybe kind of, maybe even dilutive to returns. So, as we think about in venture, it being really a two-sided marketplace where the best companies want to partner with the best VCs, we really do align a lot of our tracking proactively to these partners that have proven to generate outsized returns over, not just one cycle, but over many cycles. So something that, we have because of our kind of granularity of data, but it's definitely a huge part of how we track companies and source proactively. And then this is kind of just speaking, and once again, this is directs, this is realized only performance, but we think a really nice distribution in our realized direct performance. If you look at the chart, you can kind of see we've had a large majority of our outcomes there at 2x plus. Our core underwriting for the secondaries fund has always kind of been two at a minimum, but really more like 2.5x on a net basis. That's what we target. That's how we underwrite. We tend to be much more of a multiple focused secondary investor than other firms that really may be employing leverage to generate higher IRR profiles. But if you compare what we've been able to do in VC relative to buyout, we are really proud of what we've delivered here, and think based on how we're underwriting and the opportunity set that we're seeing today, that we should be able to continue kind of the core underwriting and performance.
We also think preferred securities in a time like this is really important, and one of the reasons that we always work through the company and the board. So, close or 85% of in Fund 5 we have preferred securities. Sometimes when we're doing a direct secondary, we're actually buying common from a departing employee or current employee and converting that through the company to a preferred security. And again, we're only able to do that because of the relationship we have with the GP on the board, the management team, what we're helping them with from a portfolio impact perspective. But it's a key part for us is like we really focus on the downside risk within the secondary market. This is a good example for the size of the outcomes for venture. Again, if you look at the bottom boxes here, a single company in each of the first 3 funds has returned the entire fund size, if not more than the fund size. We did have a loss here, which is much higher. We basically doubled down into a position, and we can talk about it more. Definitely some learnings out of that event, but we think that the right tail within the venture secondary market is super interesting because you can have a single fund investment that can deliver much greater returns on par with what you would expect out of maybe like an early stage fund where the loss rate is going to continue to be higher. And so, yeah, this is the quick summary, great IRR performance, good DPI, quick DPI over the prior funds. We really do leverage what we're doing from the primary fund investing perspective. We wouldn't be successful in this strategy if we didn't have the $5 billion plus that we were committing into the ecosystem, and it serves as a true differentiator for us. Quickly hit the terms, as I mentioned, 2.75 billion target. We will have the final close in December. I know somebody asked about skin in the game, so it's 1% from the GP. StepStone puts another 25 basis points onto the fund as well, and then employees will commit personally to the fund. We have, from a carried interest perspective, it's a full European waterfall, so full return of capital, including management fee, any expenses, fund expenses, and then 5% on funds. That includes tenders, strip sales, continuation funds, everything there, and then 20% on directs, and the management fee is 75 basis points, so it's a pretty good relative to what we think are traditional venture economics in a 10-year fund life. The performance, which I'm sure everybody has, happy to talk about any of that, and so I'll turn it off now and happy to answer any questions.
Very good, thank you. On the fee schedule, I know you won't know the entire fees ultimately to the investor until you know all the assets and with underlying fees. But in funds 3, 4, and 5, have you calculated what those total fees to the investors are once you add the layers of your fees and the underlying fees of some of the funds, et cetera?
It's a good question. I don't know if we have that. Let us go. We can follow up with um, our team, see if they've run that.
Okay. And this, just in general, the private equity secondaries versus the venture capital secondaries, what can you contrast the opportunities and the discounts and where you see at this stage of the market? Are they equal? Do you think the VC is having bigger discounts? What's the market out there now, PE versus VC secondaries?
Yes.
He's frozen for me. Is he frozen for you, Anthony?
Yeah. Yeah, I mean, I'm happy to take it if he's frozen up. I would say comparing and contrasting from a discount perspective, you typically always are going to see a wider spread on discounts favorable to venture versus buyout. Some of that just structurally because of the inefficiencies in the market where you have where you have fewer brokers, you have fewer buyers. So what you're seeing, I think also just from a risk perspective, all of those things lend to better pricing generally in venture. One of the things that I think is interesting as you think about venture versus buyout as well is, the tail end of a buyout fund tends to not have the highest quality assets. Most of, the highest quality assets are recapitalized or acquired probably about midway through fund life. And what you end up in buyout at the end of fund life are probably more of the remnant underperforming assets, which is why I think in secondaries or continuation funds, you sometimes don't always see the highest quality underlying portfolio companies in buyout. In venture, you can probably almost always guarantee that you're going to have the highest concentration of NAV into what are the most scaled businesses. Most of the GPs are incentivized to let the best assets run and compound as long as possible, which has really been one of the huge value unlocks and kind of the alchemy of venture secondaries is that even when coming in at a later stage, a lot of these businesses still have a much longer tail and can really run from a market cap perspective. And that was one of the things that we saw with Roblox, certainly as part of the Altos transaction, both directly and through the continuation fund that we structured. So, that's really the big magic in venture is that, we kind of have this embedded advantage at, finding great assets, structuring some of these deals in a very proprietary nature. But just having a lot of advantage in selecting, what can be category defining businesses and really building a kind of concentrated pool of capital behind some of those best ideas.
All right. And then one of the chat questions, how much autonomy does Greenspring have with StepStone? Or is it all one big happy family now?
All one big happy family. I would say one of the things that, was probably most important to people like Stephen and myself on the investment team was, at the time of the acquisition, the question was, are they going to change process and decision making? We've obviously been very successful at generating returns over the course of 2 decades, and really they haven't tried to change any of that, which to us has been the most encouraging. So our decision making process, our investment diligence process, all of those things remain basically fully intact. We do have the 3 new partners that can bring additional insights and perspective from their relationships, from StepStone's advisory business and from some of their growth equity manager relationships. But for us, the things that feel different are probably more compliance and operationally oriented things that you would imagine being a part of a really large publicly traded business, but not necessarily things that change how we invest or the decisions that we make.
Very good. And then on the pre-submitted question, the first one, there's a couple you said that you wanted to put off. Do you remember which ones I shouldn't bother with?
Yes, the QSBS and the K1s.
Okay. When StepStone refers to acquiring assets at a discount, what is a reference point? We kind of went over that, but I think you covered that already. If it took 2 years to spend 1.3 billion from previous funds, Fund 5, we only have 6 months left before the new fund, Fund 6, capital call date. How can you spend $1 billion remaining from the previous fund within that short span of time? If not spent, will that push out capital calls for Fund 6 from Q1 into Q2 of 2024?
I mean, I think we've looked over time. Oh, go ahead, Stephen.
So I think we will do the funds sequentially, and so Fund 5 will finish before Fund 6 starts, and we think that's important from a fees perspective for everyone that's involved. But as we look at, if you look at like some of the prior quarters of the deployment, there's really kind of like a dead point when prices were just like the market was broken. We've seen the market continue to come back. As I mentioned at the start of the call, just this week there is a $1.2 billion transaction and a very well-known manager that we got an early look at to close before the end of the year. We're not going to do all 1.2 billion, but if that was something that we really wanted to lean in on, we would have a pretty hefty check. We're also looking at a transaction which again has 700 million in NAV. Again, we wouldn't take down the entire thing, but we feel like that would be a meaningful check out of the fund. So it really we continue to deploy capital. We think the market continues to come back, but particularly on some of these GP-led transactions or strip sales or otherwise, like these are opportunities to put significant capital to work, and that's what we've been focused on. They just haven't been there, so we've been engaged with the GPs on them.
And specifically on this fund, you'll call the capital between, I guess, the first close in August and the last close in December. When will you deploy all that capital? What's the timeline or the plan?
We won't. Just to clarify, we won't call any capital until Fund 6 comes online in 24. So these will be dry closings.
Oh, okay.
In August and then ultimately in December.
So then when you call the capital in 2024, it would be over the year or be upfront?
No, it'll be called over time. So I would anticipate at kind of fund size and run rate of what we think is healthy deployment, you should think of this as being like probably a 2.5 year type deployment cycle.
And you would invest that equally over 2.5 years as well, call and invest. So the opportunities won't be front loaded. It will be spread out over a 2 or 3 year period.
Correct. Probably more of that put to work, over the first, call it 2 years than the last, 6 months.
Yeah. I mean, the opportunities you see now versus a year ago, can you compare and contrast what the difference is in the opportunities that are being presented?
Yeah, I mean, I think at a high level, a year ago there was probably not, at the same time, there probably wasn't still a ton of activity because people weren't totally sure where the market was going and where marks were generally. So I think that's why for us, we kind of saw what was happening as, managers were still trying to figure out how to assess valuations from last round and whether people were going to be taking discretionary markdowns along the way, which, ultimately we saw people do probably 20 to 25% discretionary markdowns. We think once investors have settled into recognizing that the capital market window is probably going to take some time to reopen to where there is a stream of more steady liquidity. That's really what has driven the opportunity set on the LP interest side. So, if you look at our original 3 funds or 4 funds, very heavily oriented towards expansion, growth stage, and late stage directs. But we were also at a time where the capital market window was generally wide open. So a lot of those businesses could raise capital at the growth or later stage and then, ultimately reach an exit much faster. Now that window, a lot of companies recognize that the window is probably a little bit further out than where they thought it was. And so, as a result, for companies not exiting, then that's certainly going to mean less liquidity available at the fund level and then through, the underlying LP level. So we're just seeing people really being cognizant of, if you want to have a more consistent deployment schedule, you're not going to have kind of distributions to offset some of the capital calls that continue to roll in. And we think that's persistent for the next 24 months for sure. and probably certainly into 2025 as well. As Stephen mentioned, the continuation funds, which we think will come online, it won't really impact how we underwrite, but because the manager discretionary write-downs have been larger, it means our effective underlying discounts can be a little bit more narrow. And when those bid-ask spreads or the bid-ask spread, whenever it kind of shrinks to probably 20 to 25%, then you can really get GPs excited about taking a liquidity solution to the broader LP base. Most GPs don't want to take those solutions to the LP base whenever it's a 50% discount. It would certainly call into question their marks from their LPs, and so it's just not a conversation a lot of them want to have until the bid-ask spread is a little bit more narrow.
All right. The next question pre-submitted. We were told the previous fund's DPI of 1x achieved in 4 years. The investment period itself was around 3 years. How can a 1.x DPI be possible with only one additional year from the close of investment period?
Yeah, I mean, really where we were at from a cycle perspective, we had a very, very open capital market window. So as I was mentioning, you had companies that could do our growth or a later stage kind of venture financing, and then ultimately were able to hit the exit, whether that was an IPO or potentially M&A, or even in some cases recapitalizations if they were more profitable type businesses with PE funds. But there was just more robust exit activity. So our third fund, I believe, Stephen, keep me honest, I think it actually did it in 36 months because of early exit activity. We would never promise that we could achieve that again. I think we were in a unique time. That was a 2018 vintage fund. So, you really had companies that were exiting in 2020 and 2021 at that time. But we do think, 4 to 5 years, it may take a little bit more time for some of the companies today to ultimately exit. But, we do think if you compare and contrast venture secondaries versus venture primaries, you will always kind of have a much better duration profile on a strategy like this than you may have in one of the primary funds, where our fund of funds, for example, could take 9 or 10 years to break 1x DPI.
And elaborate more on the difference between Spring and VCS Fund 6.
A lot of it is structural and kind of logistics. I would say opportunity sets are consistent because they sit within the same allocation wheel. And so Spring really just has different suitability requirements. Within secondaries, you need to be a qualified purchaser. The ticket size minimum is $1 million, or in an aggregate $1 million from an RIA. Whereas when you look at Spring, it's really a registered fund. It's an evergreen fund. There's quarterly liquidity, but it's a qualified client fund. So $50,000 minimums. And then it's also 1099 versus K1. So, kind of opens the aperture to some other investor types that may not have traditionally been able to access drawdown funds. But Stephen, anything else that you would add on that?
Yeah, and then beyond just the logistics and infrastructure from an investment perspective, the Venn diagrams don't overlap all the way. If you look at what we're doing within Spring, it's much more IRR focused, and so there are opportunities that won't be a fit for secondary. So if you were underwriting something to a 1.7x multiple, but it's still a 20% IRR, like we can put that in Spring. On the other side of that, though, if we're underwriting something that has like a 7-year hold, like we're not going to put that generally into Spring. So we would underwrite that more for VSF, just given the hold period. So there is some overlap if you have something that's like a 4 or 5 year hold and it's a 2.25, 2.5x underwriting case. Like those would go into both vehicles, but there's plenty kind of like on both sides where as we drill into the underwriting and our view on the exit timing, it probably restricts it from Spring or is a better fit for Spring and vice versa.
And I mean, projected returns for this fund versus Spring, are they not higher? Is that my recollection?
Yeah, I mean, we should outperform just on the illiquidity, to compensate for the illiquidity. If those that's our expectation.
And since this is a closed-end fund, you won't do markups after you buy them like Spring does when you buy at a discount and then you mark it up the next quarter. How will you show valuation going forward, or will you?
Yeah, we run a valuation process. Anthony actually runs the valuation process every quarter, and so we will take the marks from the managers as an input, but it's not a one for one.
Okay. And an earlier question, you mentioned all the partners are the same. Are they contractually obligated to stay for so many years from the merger?
They do. Yeah, they do have a earnout retention agreement. Trying to think of the right word. And they are also in the key person of the specific fund.
Okay. And how much is inbound versus outbound search for secondary opportunities?
It's a good question. I'd say I laugh a little bit because sometimes a lot of what we're doing is education in advance of something, and then somebody comes to us with, hey, now we want to do it. So there's a lot of prep work where we're doing to sort of like get the market ready. We want to be very proactive. I think, as I mentioned, part of the reason we have such a big team is to be proactive and outbound. Like, we just don't think sitting by the phone is as effective. At the same time, though, given our position in the market, given that we tend to be the partner of choice for many of these GPs, we do see a lot of inbound as they have LPs that call or they have solutions that are problems that they need to solve.
All right. Are there penalties for skipping these dry closings?
There will not be any allocation after the final close. So, the close in December is the last close.
And we may do this offline, but I think the minimum for the group was 200,000, or might be 200,000. Is there any chance it could be 100? Is that something that if we hit certain thresholds, $5, $10 million, et cetera?
We have to keep it at 200 because we can only have 2,000 LPs.
Okay. And let's see, I think we skipped one up front. No, I think that's any more. If the chat has any more questions, we're got about 5 minutes left if you want to add any. And I guess it's in general, the size of the fund doesn't bother you. That you think there's more opportunities out there than this fund will be the largest to date, and so finding opportunities you won't have to take some things you wouldn't have taken otherwise just because you have all this money sitting in your lap.
Yeah, our view is really like scale actually is a little bit of a weapon here, because these GPs have, as I mentioned, like $1 trillion in unrealized NAV, and particularly some of these big funds. Well, I mean, it's like you don't even have to be the biggest funds anymore. You could have $1 billion in NAV, and it's important for us to be able to lead those transactions so that we shape it. And to lead it, you're going to need to write a couple $100 million check at a minimum. And the way we did it with our Altos transaction was we wrote $100 million out of our own funds across several different vehicles. We syndicated $100 million to our LPs, but that's a process that you don't have as much certainty to close. So we actually think the GP leds were the lever that really led us to increase the fund size. And obviously it's been strange for us with COVID. That kind of has broken down with some of the changes in the market. But as they've started to come back here in the last quarter or so, we feel like that's going to continue to be a big lever, big leg of the stool.
And for investors that want to invest, the next closing is when, and how many more closings will there be, or is it just a perpetual closing?
Final close in mid-December.
But if we wouldn't close until mid-December now, or
that's right. Yeah.
The next closing is the final closing, which is mid-December. So we have till mid-December right. to do anything. And is there any possibility that the final closing is over allocated and we would be allocated a smaller percentage, or first come first serve or something?
Yeah, right now it's looking like it'll be like a 15 to 20% cut.
Okay. And can you go over the process for investing, who to contact, how it's done online, etc.?
We use Plus Subscribe, and so it's done online, and I think Schropp has the contact at Alyssa and Claire on our team, and he's got the emails, and they can set you up with Plus Subscribe to do the documents.
Very good. I think that's the end of our questions. If anything you'd like to add in closing?
Yeah, just one quick question. Stefan, this one request. We have a lot of investors who are coming from Fidelity. I understand that there's no issue with Schwab and TD Ameritrade, but just please put your best effort to integrate the solution with Fidelity so that a lot more investors have access to that.
Yeah, totally. Like as you said, Schwab and TD, we've been able to get done, and the team is working with Fidelity to try and get everyone on board so we can do the integration there.
Very good. Well, thank you for your time, and I'm sure you'll be hearing from our members.
Thank you, Mark. Thank you, Schroff. Thank you, everyone, for your time.
Thank you. Have a good day.
Thanks, everyone.
Thank you.